Tryg, the largest non-life insurer in Scandinavia, just reported their Q1 2023. I'm standing here with Head of Investor Relations, Andrea Roberti, who promised to give us a few words on the result. But first of all, congratulations with a very impressive result. It seems like you beat most of the metrics compared to consensus numbers. But could you first put a few words on the new IFRS 17 that you implemented, please?
Thank you so much. The new accounting standard for European insurers, it's called IFRS 17, has been long in the making. We work on this for more than 5 years. Thankfully, this has not much impact on our figures. Tryg has been reporting mark-to-market of assets and liabilities for many years already. So in reality, if you look at our comparison figure, most of these are unchanged. Pre-tax profit, net profits, and shareholders' equity are unchanged. It's a big deal for the sector. There's going to be a lot of change, a lot of discussion, but less so for Tryg and many of other the Nordic peers.
And could you also put a few words on the result? What went well in the quarter, and where do you see some room for improvements?
Yes, we reported an insurance revenue growth of 4.6%. Actually, it would have been a little higher, around 5.5%, adjusted for a customer conversion from the HC Scandinavia acquisition. The insurance service result was 1,474 million. It showed a big jump compared to the first quarter last year. We were somewhat lucky in terms of large and weather claims experience. That was significantly better than the first quarter of last year. Interest rates were higher. This is a little bit technical, but higher interest rates improve our claims ratio because we report lower claims expenses in the P&L. And also, we're also satisfied by the investment result, thanks to a relatively good capital markets condition in the quarter.
You end the quarter with quite an impressive combined ratio of 84 compared to 88.9 a year ago. Could you put a few words on this large step? Has there been sort of any extraordinary items that we should correct for?
It's an important question because what I mentioned previously regarding large and weather claims has an impact of around 180 million. So there's a delta of 180 million by lower large and weather claims this year versus last year. So, and you know, it's primarily randomness. At some quarters we're worse than normal, some quarters we're better than normal in terms of large and weather claims experience. The higher rates also help, something around 200 million. We have an improved underlying performance that help around the 60-65 million, but it's important to realize the currencies actually moved against us, and there's a drag from currencies of around 50 million. But if you put all this together, that explains the bridge between last year and this year in the insurance service result.
And could you also please give us an update on how the RSA Scandinavia integration is moving?
Yes. We produced synergies of 64 million in the quarter and 470 million since the start of the integration. One should remember the overall target is 900 million for the full year 2024. In the quarter, I can mention different things as usual. We see synergies from procurement by utilize on a pan-Nordic basis our procurement power. We see synergies from shutting down a couple of IT systems in Norway. And we see synergies also in the commercial part by utilizing a more pan-Nordic platform. So it's progressing well. It's 470 versus a full target of 900. The target for this year is actually 650. So we feel we are on track.
You're planning to pay out a quarterly dividend of 1.85 Danish kroner for Q1 23. That's up around 20% from last year and around 15% from the previous quarter Q4 22. Could you please give us some flavor on this improvement, and also what's the mechanism behind the dividend levels you opt for?
Yes, I think from our perspective, the most relevant comparison is really Q1 last year. So we see the dividend per share up 19%, precisely as you say. We have a guidance that says that on a full year basis, approximately 60 to 90% of our operating earnings are paid out in dividends. If you look at it historically, that has been the broad guidance. We've been at the high end of that 60 to 90% because we recognize that dividends are very important for our shareholders. So that's really the indication. and 185, and the jump of 19% is primarily driven by the fact that this year we will fully consolidate all quarters the RSA asset, and the synergies will show a step up versus last year. Obviously, once the acquisition is finished, the dividend growth will be lower than 19%. But we're very pleased about this jump, and we're very pleased that we can offer a good dividend story to our shareholders.
Thank you very much, GM.
Thank you.